Take your seats. We're gonna go ahead and get started. I'm Geraldine Gardner, and I get to have the pleasure of being the executive director of the Centralina Regional Council. And just so pleased to have all of you out on a beautiful Friday day to end the week talking about our economy. So there's a lot going on in the world. And all of what's happening in our economy affects what's happening here in the greater Charlotte region. So we are just delighted to have Professor Scott Baier from Clemson University here to help us make sense of some of the things happening in our macroeconomic trends and what that might mean for your local governments and the budgeting processes that many of you are in the middle of. So really thank our elected officials that are here, our chair, Mayor Scholl from Stallings, and our vice chair, Tony Long. Thank you for being here. So we are going to jump into our presentation. On the back side of your agenda, there's a little spot for notes and some discussion questions that after lunch, after the presentation, and we get a little lunch, we're going to just be having some reflections and thinking about, like, what did you learn from the professor's talk, and how is that influencing how you're thinking about your budgeting process and trends in your community? So we want to just have that discussion to round out our time together. So with that, Professor, you're up.
That's a lot of pressure on me.
Yes.
All right, thanks for having me, and thanks for coming out today. As it warms up this weekend, so a little blast of cold air earlier in the week. So I'm going to zoom out for a lot of the talk, but also zoom back in on some things that are going on locally. I will say up front, normally in the morning, I'll go through some last minute changes on my slides, things that I thought about or some corrections that I made. Yesterday driving in, I had a little incident in which I decided to stay roadside on I-85 for 4 hours while a tow truck came and picked me up. So I don't have some of the corrections on the slide that I would like to have, but I'll try to make them seamless so that you don't realize that I've made some mistakes. So here's one that I'll just blend in naturally because it is something that was relevant that came out this week. Is that this week the Fed decided to hold interest rates constant. There was some talk a little bit earlier that they may try to push down the federal funds rate. But I think two things now that are working against that. One is the preferred measure that the Fed uses to look at inflation, the consumer price index that they look at. Is at reading at 3.1%. That's well above their target rate. And when it sits that high, they're going to be very reluctant to lower interest rates. You layer on top of that the conflict in Iran that's pushing up gas prices. And now they're looking at those inflationary pressures as being too much now to push interest rates down. Even though the job market and labor market seems to be lagging a little bit and would give them reason to lower interest rates, their primary goal is to keep inflation in check, and they're not going to repeat some of the mistakes they made back in 2022 in addressing inflation. So again, they're taking a pause on pushing interest rates down. So the near term and intermediate term economic growth showed mixed signals for 2026. Most forecasters, and I'll agree with this, put a chance of a recession this year at about 33%. But again, I think things in general look relatively positive, and there could be some upside potential as we go along. What ended up being a real surprise this last quarter was all the way up until like 2 days before the GDP numbers came out, they were expecting Q4 GDP growth to be about 4 or 5%. They came in well below everybody's expectations at 1.4%, kind of shocked the whole system. And if you looked at the market that day, it kind of reflected that. And that whole year was kind of a mixed bag. If you go back and you look at the first quarter of 2025, GDP growth was actually negative. And why was it negative? That was negative primarily because a lot of businesses, especially manufacturing companies, were trying to get out ahead of the tariffs. And so what they did is they kind of switched away from what they would have normally been doing. And then they tried to import inventory so that they would be kind of insulated from tariffs a little bit. But that whole activity acted like a little bit of a drag on that first quarter. And so we had negative GDP growth that first quarter. Then the second and third quarter were quite good rebounds, 4.4, 3.8%. Actually looked pretty good. And again, we were thinking Q4 was going to be relatively high. It came in low. So for the year, overall GDP growth came in about 2.25%. Not so hot. Again, the conflict with Iran has elevated oil prices, and that's likely to be a little bit of a drag on the economy. I did some work on this morning, thinking about it. And the one thing one takeaway that I would like to say, that I'd like you to take away from this, at least this is my belief, and of course it depends on the duration of this conflict, is the oil shocks that we face today aren't like the oil shocks that we faced in the 1970s. For one, we're not nearly as reliant on oil and gas as we were back in the 1970s. We cut our energy use in that sense in the production side by about a third. And then in addition, we're no longer a net importer of oil. So it's even different than 2008, back when I was working in the Bush administration. We were a net importer. Now we're a net exporter of oil. So that also gives us a little bit of a cushion. So my back of the envelope calculation, if this same shock would have hit us today and we look like we did in 1979 and it would have lasted about a year, it would have pushed down our real wages or our real income by about 10 to 15%. It's still going to have a negative impact, but it's going to be much more muted, between 3 to 5%. And that's if they stay elevated for a year. If things clean up, and the passage in the Gulf clean up and oil returns to its kind of normal flow, it'll be less. But again, it'll be a drag on the economy, but not nearly as bad as it once was. The job growth is the one main concern, and I'll highlight this and talk some more about it. Job growth is really showing some signs of weakness. Total non-farm payroll employment fell by 92,000 in February. And so if you look at the first 13 months of the Trump administration, the economy's only created about 125,000 jobs. And again, to put that in perspective, and I think you'll see it later, on average, the economy in any given month normally creates 125,000 new jobs. So over 13 months, we've created the number of jobs that are usually done in a single month. And that's a real concern. So a quick overview. These are things that you probably know better than I do. The Charlotte MSA has an unemployment rate of about 3.6, well below the national average of 4.4. And the population continues to grow between about 35 to 40,000 people per year. And I'll talk a little bit more about immigration with some later slides. Total non-farm payroll in the MSA is about 1.25 million. And again, I think one of the things that benefits this area is the diversified employment that's in this area. Unlike the area where I grew up, in which we were almost completely reliant on the auto industry. I grew up in northern Ohio, close enough to Detroit, that once that one industry was hit, that kind of hollowed out the whole town. Charlotte has a relatively robust employment diversified portfolio of different industries: financial service, healthcare, technology, logistics, advanced manufacturing. All of these things can cushion against one shock that hits one industry. Job growth here was relatively robust. Again, 2.1% per the year, well above the national average. The Charlotte MSA's GDP is about 240 billion. Average per capita GDP is about 65,000 per person. And the GDP growth in this area is expected to outpace national growth. And I think that'll continue for the Carolinas, both North and South Carolina. This is the place where individuals want to move to. This is the place where corporations still want to come to. And so again, what I would anticipate is over the next year, no matter what shape the overall economy is in, that this area will outpace the national economy, both in terms of GDP growth and employment. So again, an outlook, Charlotte MSA benefits from strong in-migration. We'll talk about that more in a bit. Again, relative to the Northeast and the West metro areas, outlook is a very business-friendly regulatory environment. And the diversified amount of employment and production, again, allows you to absorb some negative shocks that may be impacting certain industries, certain occupations that the area can absorb. So again, that's a kind of a big macro view of the Charlotte MSA. Now, zooming back out.
Sorry. Hello.
Oh, I'm sorry. Yeah, I mean, feel free to ask questions. But make sure I recognize them.
And all the numbers. So on the last slide, does that also take into consideration that we have seen around the region a number of manufacturing layoffs, anywhere from 50 to a couple of hundred individuals?
Yeah, so this is the net impact of that. So it's jobs lost and jobs gained. And I had a better look at that nationally, not locally, but that's the net impact. Good question. And again, feel free to ask questions, and if I'm not paying attention to you, just make sure I focus back in on you. I apologize. So, oops. I'm sorry. Hold on, I can go back. Maybe. I won't go back. All right, so I'll just go for it. So this is looking at real GDP growth. And if you remember anything from a macro class that you may have had in college, and you haven't purged it all from your mind, remember real GDP is a measure of income. It's also a measure of production. What I'm trying to highlight here that was kind of on the last slide, but it's on, repeated here, the long-term average growth for the U.S. economy is about 3% per year. In the 2000s, we've underperformed the national average by quite a bit. Only a third of the time has GDP growth reached that long-term average. And so again, this isn't something that's particular to the Bush administration or the Obama administration, then the Trump administration, the Biden administration, the Trump administration. It cuts across all of these different administrations that the economy hasn't performed as robustly as it had if you go back from, say, the 1940s all the way up until the 2000s. Here's kind of looking at that picture again highlighting that in the first quarter of last year, we had negative growth, 2 really good quarters of growth, and then kind of a mediocre quarter to end things. Oops, did you get it? Okay. This is a graph I put together right before I came, and I think it highlights some things. It also has some things on the last graph that I blew past and didn't say anything about. Again, this graph here is mapping together both employment and GDP. Both of these graphs capture the last 2 recessions that are much different than any other recessions that we had. This is the Great Recession. Again, most people call that the housing bust. I no longer think of that as a housing bust. I think it was a recession that was due to structured finance. But that was an L-shaped recovery in which the economy went down and never bounced back up like we typically see. So it had that L shape as we went down and then continued along the last row. So in some ways, this was a man-made or person-induced type recession because of structured finance, kind of mucked things up. The other one is the pandemic, in which you see your typical V-shaped recovery, in which you go down and then it bounces right back up. And again, that makes sense because there was really nothing structurally wrong with the economy at that time. We were just hit with this large outside shock, this virus, it made us all shudder at home for a bit. And then when things opened back up, we kind of went back to where we were before, not to downplay the loss of life that occurred.
Question.
Sure.
Can you explain the difference between the income line and the employment line, why it diverged, stayed that way?
Yep, and that's what I'm on my way to do right now. Perfect, good. Great question, so I can answer that one. So from 1980 up until 2000, inflation adjusted GDP grew by about 3.25%, and employment was growing at about 1.85%. What was really helping GDP along at that time, there were a couple things that was helping GDP along and employment along. The first thing on the employment side, I'll come back to that. On employment side, there were demographics that worked in favor of both labor force and helping GDP. You had the demographics of the boomers kind of moving in and being at mature stages in their life where they were going to be most productive. You also had a big shift in terms of female labor force participation over this time period, not only moving into this labor force, but also going into occupations that they may not have held before. All of those things, not only did it help employment, it also boosted productivity. So again, this 3.23% was partially bolstered by, again, the employment number. Each new person employed helped boost GDP growth, but also they became more productive, moving into different occupations, again, and in different stages in their life. So those things move things along. And then also, again, at the same time period, in the 90s, we also had the tech boom that also increased productivity and helped move things along. When you get to the 2000s, the demographics started to move against us. Some of the boomers began aging out. And if you remember in 2008, again, coming out of the recession, some of this group took early retirements. And then female labor force participation sort of reached a plateau where it hasn't gone up. And again, that acted as a drag on employment growth. And again, it actually pulled down income growth a little bit. The interesting thing is, I hope I put it on this slide. We'll see. Is you kind of see at the end here, and this is what we don't know, you have kind of a leveling out of employment. Again, population just isn't growing as fast as it once did. And you get this little kick up here. And what we're trying to discern, so that kick up means that labor is becoming much more productive. What we don't know yet, too early to tell, how much of this is being driven by AI increasing worker productivity. Again, if we have time, I'll talk a little bit about more AI in the economy. But I think you can see a little bit of here at the end as labor kind of flattens out, we get more output, and that could be AI making workers more productive. So again, now I'm going to kind of walk through what I think is going to be pushing income along and what's going to be impacting things for the rest of this year and into the intermediate term. In the long run, of course, GDP is driven by the factors of production, the input side. GDP increases are driven by the productive capacity of the economy. And that's going to come through increases in the population, increases in human capital. You have a more skilled workforce, or people have skills that move into areas that are going to be more productive. Increases in GDP in the long run are going to occur from capital deepening. By that, I mean more plants, machines, equipment, increasing the capital stock, and then increases in productivity. Again, kind of hinting at, what is AI adding to the economy? How more efficient are we using our capital and labor to produce goods and services that people want? So those are the drivers in the long run. The short-term fluctuations end up coming more from the demand side, from consumers, from firms investing in plants, machines, and equipment, from the government, and then through international trade. So in the short term, GDP is going to be influenced by demand side factors on consumption, investment, government spending, and net exports. So if we go into, if we're looking at what's likely to cause a recession this time, it's most likely to come from the demand side rather than on the supply side. So I'm going to talk quite a bit about the demand side and see what's playing in here. So again, just so you can imagine how big each of these actors are on the demand side. Remember, consumers are 2/3 of the economy. That is 2/3 of all income or 2/3 of the consumption that is consumed, or 2/3 of output that is produced goes to consumers. About 20% goes to the purchase of plants, machines, and equipment investment. About 20% goes to the government, and then you get exports in here, net out to about zero. So again, the big driver of the economy in the short run are going to be consumers. Investment, which you'll see is the tail that wags the dog. Even though investment is a lot smaller than consumption, it's the one that's much more volatile, the one we kind of have to keep our eye on. And I'll talk a little bit about government spending. If you look at consumer behavior has been pretty good. Again, this is a bar chart showing how much on average consumption contributes to GDP growth. So again, the way to think about that, this is last semester. Sorry, I'm in college right now. Last quarter, consumption contributed 1.58 to GDP growth. That means the other factors, government spending, net exports, and investment, counted a negative amount to get us back to 1.4. So the big driver last time, again, was consumer spending. And again, what drives consumer spending? It's somewhat obvious. It's how are consumers doing in terms of real income? And so this is real disposable income. And a couple things are obvious here. What is this right here?
Stimulus.
That's all the stimulus, right? So those are the stimulus injections that occurred. And again, this was in the middle of rarely do we ever see in the middle of a recession, people's disposable income goes up. But that's what the stimulus did. Now, we can give the stimulus some credit because it did help consumers bounce back up. But as we'll see, and I'll talk about a little bit again later, is this stimulus again was probably the impetus for the inflation that we experienced at that same time period. Notice when the stimulus went away, that real disposable income kind of lagged a little bit, and you'll see some of that in the job markets. And then it bounced up, and now it's coming back down. But overall, when you look at income in terms of how it impacts consumers, were right on trend. So that's kind of a good way to think about consumption. That income is right on trend, and if income is right on trend, consumption should be about on trend. But there are some concerns I have on the consumer side that I think are apparent on the next slide, and this is looking at household debt, not including mortgages, because that looks a little bit different. There are a couple of things that obviously stand out here. Is this big rise in credit card debt. You're also seeing the student loans tick up a little bit, but not much, and then auto loan debt. In fact, all of these forms of household debt away from mortgages are starting to kick back up, and we're starting to worry again how levered households are. And when you take a look at the data, kind of what's underlying the data, you also see it in some of the consumption pattern. That while consumers on aggregate look good, not all of consumption looks good for everybody in the economy. So if you look at consumption growth, it's become more dependent on higher income households than earlier stages in this recovery coming out of the pandemic. Right. Obviously, in some sense, because households had all the stimulus that they could spend out of, right? So what we see now are lower income households that once had all that stimulus money. If they didn't spend it all right away, they held some of it back. Now all of that is depleted. The recent credit card data also show rising delinquencies. Not only is the credit going up, the credit card debt going up, the delinquency rates among lower income houses are going up again. And then if you look at what people have been spending on, I don't know that this is true. I mean, I know that part of this is true. Let me say it. Spending growth has been stronger in travel, restaurants, and high-end services and durables. Those are things that higher income households typically buy more than lower income households. So if those have been the sure.
Can you give us a income range of the lower income households?
Yeah, so the lower income household, I would say, would be anybody below, again, I would say kind of the 65,000 in this, yeah, in that area. But I wouldn't bet on that number. But that's about, okay. Oops. So again, the consumer looks kind of healthy, but it's uneven. And again, from a macro perspective, why would I care about this? When consumption tilts this way, consumption becomes more interest rate sensitive because it is the wealthier consumers that are buying this and the ones who have the portfolio. So consumption is going to be more sensitive to interest rate shocks because that can impact people's wealth. It's going to be more sensitive to wealth corrections. So with stock market dips, and it's going to become more reliant on asset prices and credit conditions. So those things now, shocks to interest rates or corrections in the stock market may have more of an impact on consumption because those are things that the wealthier households base more of their consumption on, and they may pull back some of that. And the affordability crisis, you know, you can't go without talking about this in some, so I hope I pay it justice here. So what's driving when we talk about the affordability crisis? I talked about some of this in my previous talks over the last year, but I didn't use such elegant terms as the affordability crisis, which just seems to get a lot of play. But what's driving it? From 2021 to 23, inflation surged and prices rose overall by about 18 to 20%. And one thing that you know, it's on the next slide, but I'll state it now. The one thing I wish politicians would not do, both on the left and right, is promise they're going to bring prices down. Because once you have overall inflation that hits the economy like this, that's where we're at. And as much as I don't like going to the grocery store and spending $120 to buy a family of 5 dinner, I don't like it, but I know we don't have periods once you have, if you've been through the 70s, you know those prices don't go back down. So I think some way the government is doing a disservice to us, promising that prices will fall back down. What we're experiencing now is slower inflation, or disinflation is what it's called, and I teach it in my class, but I think that's a terrible term. Slower inflation means prices are still rising, but they're rising slower than they were back in 2021, 23 at 3.1% or 2.8%. The real dominant thing of the affordability crisis, and this is the thing that I've argued, is housing. Housing is the dominant driver that a decade of underbuilding nationally and restrictive zoning and now we have elevated mortgage prices, it has really created a structural shortage for housing. Okay. That, again, the underbuilding and now the higher mortgage rates have really caused an issue in the sense of is a lot of people who might consider moving before will no longer consider moving now because they're sitting with a 3.25% mortgage rate. And if they would have moved out of that house, that would have opened it up for somebody else, but they're like, I'm not moving away from that mortgage rate. And that's kind of locked in and slowed down the churn that we normally get in the housing market. I also think one of the issues is that with the housing thing, so I think a good part of it is the supply, and I'll say more on that later. Mortgage rates are a problem as well, but also that into the groups who are looking to move into their first homes, we don't have, let me get this on the next slide, don't have the homes that they typically would move into as starter homes. But it is also the case that their vision of a starter home is nothing like what a real starter home is, right? They're expecting, my kids are expecting to move into the home that we ended up living in, not the one that we lived in when I first got married and when we first started having children. Again, so there's a misalignment of expectations, but there's also a real construction problem. And I hope all of this is on the next slide. What can policymakers do? Again, sometimes we do have supply shocks, whether it's the avian flu that impacts eggs prices or frost in Florida that impact oranges and orange juice prices, or like we have now with petroleum and oil. Those type of shocks are to specific things. They're one-offs. They typically lead to a rise of prices and those things typically fall. So you do get some prices fall when they're weird kind of supply effects. But as I mentioned, promising to lower prices from demand-driven inflation is either economically illiterate or deliberately misleading. And I'm not saying what the politicians are doing, but it's one or the other or both. Once we see inflation overall, all through the grocery store, we should not expect prices to go down, and neither should they, and they shouldn't promise they will. Addressing the housing affordability really requires supply side reform. Freezing rents or holding rents or price controls don't seem to get it done. In order, if we want to solve the housing affordability problem, it leads to supply side reform, zone permitting and construction, not Fed cut rates, or executive orders on grocery prices aren't going to solve the affordability problem. And here's kind of a one chart I saw, I grabbed 2 days ago that I think highlights this. If you look at rents in cities, the cities that built are the ones that had rents falling. That Austin, Texas, Nashville, hey, good job, Charlotte, are the ones who had falling rent prices. And if you look at the ones who didn't have falling rent prices or not as much, they were the ones that were building less. So for the Charlotte area, again, Charlotte home prices are up 2 to 3% year over year. Again, it's a steady appreciation. It doesn't look, at least to me, like it's a bubble or something that's going to crash. The inventory has been rising. From what I could gather, looking at the data, there are 10,000 active listings. That's up quite a bit. Also, the one thing I'm seeing too, I was looking to see how long does it take to turn over houses here. It's been roughly constant, about 51 days is the average time on the market. At least that's what I could see from the data. So again, not moving in one direction or the other, but again, 51 days I think is below kind of what's the long-term average. The MSA added nearly 29,000 housing units in 2024, the data that I could find available. And it's led to the first supply surplus in years. Apartment construction has been record high. So again, the takeaway I have from here about the Charlotte area is it continues in a positive way on addressing some of the supply issues. Again, it makes sense because this metro area, the land is relatively elastic for the most part, or there are places in which you could build. It's not as compact as someplace like New York. So if you have the opportunity to build, and that puts downward pressure on home prices. So again, in terms of national average, Charlotte continues to outperform national trends, both in terms of sales activity and price stability. I'm not sure you knew that, but again, I thought that was, again, I've kind of known this from afar. I kind of settled in on these numbers looking at this.
Professor Baier.
Yeah.
Quick question. When we're looking at these numbers, are you or do you know if anyone's also taking into consideration during the pandemic, the increase of single family REITs and the fact that corporate buyers also contributed to our low housing supply? So in Charlotte alone, NACA was in Charlotte earlier. It was out the last year, 24, but they identified back in May of that time, over 100,000 single family homes that are owned by investors. And then not thinking of the mom and pop investors that own over 100 homes. So and the new build to rent single family homes that are also homes not in the market. When I hear a number of these reports, the default is that government needs to release some of our legislation, but I'm not hearing that releasing that doesn't stop the investors from coming in and buying up entire neighborhoods.
No, and again, I don't address that all, and I'm gonna be completely frank, is I don't know to the extent in which that's impacting, again, the overall supply of people's overall ability. From my 50,000, 30,000 foot view, I see the numbers, I don't see how that is, and I'm not saying it doesn't, but I don't see how I can't get a sense of how that's impacting decisions and people's ability to move. And I wish I could get a better sense of those numbers. But again, I think the institutional investors I know are corporate investors are a relatively contentious issue and can limit that people's mobility. But again, I just from my view, I can't dig deep down enough to get a good sense of that.
Thank you.
So again, relative to metro areas, Charlotte remains value. Again, the one way I would see it in some sense, again, is if it was, again, this is just not me thinking, off the top of my head, is if it was really impacting the overall supply in a really negative way, then we would see faster rising housing prices than what we are seeing. Right, because that would say there's an excess demand and that would drive up prices. So the fact that prices have moderated at that 2 to 3% rise gives me a sense that that's not restricting the market too much. Quick off the top of my head, and I don't know if that's right, but that's off the top of my head. The challenge, again, I think in this area is the entry level ownership, and it remains out of reach. So only 18% of the homes sold for under 300,000 in 2025. That's down from 36 in 2021, and that's the period. I mean, I didn't live here, but I lived close enough to a lake area in which around Clemson is the housing prices just skyrocketed then, and I think the price of the house I lived in doubled in this time period. Of course, I buy it after it doubles now. The near-term risk, again, I think is any type of construction slowdown that there was a little bit of a construction slowdown in 2022, 23, and that means fewer deliveries in 26. But again, we've seen some more supply gains more recently. Again, the policy window, I think now is zoning reform, density incentives. Again, and workforce housing investments can extend the progressive pipeline when that tightens. So again, my view here is the solution to the housing problem is to build, not to restrict prices. Now going back to the macro view again, thinking about investment, and that's the purchase of plants, machines, and equipment. What we see here is at the end is all these bars, obviously the reds are negative and the blues are positive, is just, that's a lot of, to me, that reads like there's a lot of uncertainty. And again, the way I think of it, normally you see little bits of runs here. That once you go positive, you stay positive for a little bit, and once you go negative for a little bit. You kind of got to ride things out. This is, we don't know what's going on, right? It's uncertainty. Both policy-induced uncertainty and economic uncertainty are leading to these wide swings here. And in fact, this right here is, and I'll show that in a second, is again, the policy uncertainty of trying to get ahead of the Trump tariffs. Sure.
So I see that the last date on this is October of 2025. If we were to push this forward into 2026, how much of this would be impacted with the AI investments that we're seeing? Between Meta, Google, all of that, are you getting?
Give me a break, man. Yeah, I got that coming out. No, it's a great question. It's staggering, I think.
Meta's scheduled to spend more on capital investment this year than the US did in World War II.
Yeah.
And so, I mean, I just wonder how that is impacting.
Yeah, so to give the punchline, to give it away, is AI investment has been adding about 0.5% to GDP growth. And that doesn't seem like much, but that just part of AI investment is such a small part of GDP. It's like 4%. So for something to add 0.5% of its overall growth has to be tremendous. And again, to give things away, it's the fastest we've seen since the dot-com bubble. So again, on the investment side, the drivers of investment are different. You have plants, machines, and equipment. Those are mostly driven by interest rates. You have changes in business inventories, which are based on sales expectations and supply chain disruptions and what do you think suppliers are going to do. And remember, housing is included in investment called residential investment. We know that those are sensitive to mortgage rates. I'm not going to talk about all of these in great detail, but just remember, investment is somewhat complicated because there are different aspects and there are different drivers of each of these. Let's skip that for time. Oh, I guess I'll skip that one too. Maybe I can go back. I better try it.
Right.
Yeah. That one was just showing that fixed investment looks pretty good. So much of the growth in investment in 2025 is coming from AI. It's added about 40 basis points to GDP growth each quarter. And here it is. And again, you would have to go back to the 2000s to see where it was that high. And again, it's lagging, right? Like you said, if you forecast it out, it's going to be even bigger going into 2026. So it'll probably get at least back, I would say, back up into that, almost adding a full point.
The other concern is that if we go back and look at 2000, you see that investment and then you see what happened after that investment. And there are still concerns, especially in the economy right now, with the growth in AI investments and the growth that they have in the S&P. They're a massive part of the S&P. So if that falls off a cliff in the same way that it did after the dot-com bubble, that's the concern.
Finish up for me? No, you're doing good. No, that is, again, what we don't know is, again, we don't know how much AI is going to be the savior and boost productivity, or are we going to have a similar bust to that, and then we have to recover like we did. And it's just too early to tell. We don't know. But those are great points. And again, it's the investment I would argue is much bigger, is going to be much bigger than we saw there. So the potential bust could be much bigger as well. This is one thing I'll go on to say about the Trump administration. A positive thing I'll say is they remain very aggressive in terms of wanting to be, knowing it's important to win the AI race. And so they are all in on winning that race and not trying to restrict things as much, not trying to restrict U.S. development. Again, international, it's a different story. But again, I think the investment there and the support on the government side is important. Tariff uncertainty, I'm not going to talk about that.
Can I ask a question?
Sure.
Is there data that looks at the difference between that lag in the first tech bubble and AI and the relationship to the jobs that came with it? Because this is a different job scenario than we have.
Way different.
Right.
Way
So
different.
in addition to the sink that we expect in all great investments that run their course, those that succeed and those that fail drop out. There's a whole different job and workforce scenario that came along with that first tech boom that is now going away.
So what? Yeah. So exactly. So I'm not sure if it made the final cut or not. In the dot-com run up, we had the code line was learn how to code, right? And we had lots of coders getting jobs. Now, I don't code at all, hardly at all anymore. And I spend all day coding, but I don't. I ask Claude to say, write my code, and then I clean it up. So you can see those jobs going away. I'm not sure if I have the graph where I have Oh, it's at the end with my AI slides. But also, again, if I'll never make it on time here. But the one concern that economists talk about a lot with AI, and I think it really is everybody's overall concern in terms of the job market, and I think it's the legitimate right concern, some of the doomsday things are off, is de-skilling the workforce. So at one point, like to be a computer programmer, I had to pick up these skills, and now I don't need to know them. And that could be true for lots of occupations, that there were skills for individuals that you needed to know, whether it's to fix a machine or to code or do something else. And now if you could just simply ask ChatGPT or Claude or Gemini or whatever can you do those? Then you need someone, just the average person can do all of those things. And what that means is if anybody can do it, there's no premium placed on those type of workers. And so that's going to have a depressing effect, literally and figuratively, on wages, right? And then while income will go up, income will less likely go to the workers and go to the capital owners or the owners of the industry or the entrepreneurs. So that's my negative view of AI, but I also have some positive views of AI, and we'll see if we get to it. But that is that de-skilling, and I think one of the things that you were talking about. The impact on the conflict in Iran may act as a drag on investment. Just because of the higher oil prices, and I'll give you the lesson that I got from my tow truck driver on the way in when he was talking about gas prices. He just looked at me and said, "Man, it's just supply and demand." And I said, "I'm right there with you." So again, the petroleum price, higher gas prices may slow down investment some. There are also some things that are related to the one big beautiful bill that have a positive effect on business investment. And again, these are things that you have the permanent 21% corporate tax maintained from the Tax Cut and Jobs Act of the first Trump administration with accelerated depreciation. So again, what that means is you could write off, you could buy plants, machines, and equipment and write most of it off. Or you get the that's this one. You get the investment tax credit for semiconductors, and then the accelerated depreciation. Okay, so all of these things here, there's the 100% depreciation, got 100%. So all of these things here encourage investment and should help boost building capital. The fact that I get to keep, that firm owners can keep more of their profits makes them want to invest more in capital. The fact that I can, if I'm in the semiconductor industry, that if I build facilities, I can expense that. The refundable R&D credit and the 100% depreciation are all things that encourage firms to build up capital. Now, a really interesting thing I read yesterday in a recent release from the NBR. And again, it's going back to the de-skilling of workers. I didn't think about this till I read this, but it's an important thing. Now that we have capital that can do the same work as humans, right, for the most part, do we want to have rules and laws in place that favor hiring capital over consumers? Think about that, right? If I can invest and write it all off and buy a computer and buy the pro version of Claude, and it can do the work of 2 or 3 people, and I can expense all of that, why would I hire the 2 or 3 people when I can buy the computer? And I think that's something we have to think about. And again, this is great, and I think it'll help boost GDP in the short run, but it is favoring one type of input over another. It's favoring capital over labor.
Can you comment on how that might impact our region and the mix of industries and sectors that we have? Some being more capital intensive, others being more labor intensive?
Yeah, so again, I'll give a general takeaway from this is and I'll go by task in industry. I think it's easier to think about it that way. Any task that is routine, is more likely, or job that is routine, or industry that relies on routine operations is likely to become much more capital intensive, much more labor intensive. Anything that requires more one-on-one interaction, individual interaction facing forward, again, those industries will grow, and the AI will be a complement to those industries. The other would be more of a substitute. It's kind of broadly sweeping, but that's the way I think about it now. And again, I reserve the right to change this view because it's also, I think the whole structure of how production may change is I think we may go through a big change in production that we didn't do it before. And the way I was thinking about it, I come from a manufacturing family and a tile laying family as well, is that, when I worked in a General Motors factory in college, and how I saw it operate afterwards, when I look at the local companies around me in manufacturing, it's like you have something automated, and then you have an individual check, automated, individual check, automated, individual check. And those were good things. You kind of check what was going on. But that slowed things down, having that individual check. And it may now switch to, you don't want to slow things down, and you'll have a run of automation before you get to the checks. And that could drastically change how labor is used and what skills the labor has. Just because it's so, now, again, what I'm trying to get at here is now through automation, you could do a bunch of things and produce a lot of output real fast and have it all checked at the end. So what does that mean for manufacturing and production, and what does that mean for the end of line workers? I don't know, but that's just almost sci-fi for me right now. I don't see that happening in the next year or two, but I can see all the manufacturing change. Outcomes will be, again, outcomes from investment will boost short-term cash flows, potentially increase domestic supply chains. Now going on to the next part of spending is government spending. Two things stick out here, right? DOGE and the government shutdown. Those two things, because government slowed down, they actually were relatively big drags on the economy. DOGE wasn't as big as the government shutdown, but still, you pulled back on what the goods and services and employment the government was doing. That slowed down the economy. Was much bigger, of course, than the government shutdown when they weren't producing or doing anything. The interesting thing I think about this type of government, when you think of government spending, remember, and you certainly well know, it's just not the federal government, it's also local government. So if you look at federal spending and state and local, what you see is the government shutdown, federal government shutdown, took almost a full percentage point off of GDP in the fourth quarter of last year. But the good side here is, if you look at state and local spending, it's been adding about a quarter percentage point to GDP each year for some time period, right? So a couple of things is, I take away from this is, one, when you see government is adding to GDP, it's not coming from those stimulus packages that we had before. I would say it's much more organic in the sense of state and local governments typically have to have balanced budgets, so you can only afford to grow the government as the revenues come in to support it. So again, it looks like the state and local governments are doing well enough that they can support increased employment. That increased employment slide in state and local is left on the cutting floor, but trust me, in most areas, state and local government has gone up. On the government side, of course, the big concern is what's happening with the deficit and its impact on the debt. Currently, we are at a debt that's over 100% of GDP. And if we keep going like we are, which I don't see why we won't be, by 2056, the debt to GDP ratio or debt to income ratio will be about 1.75. Again, that becomes problematic. If I went to a bank and they asked me what my financial situation looked like, and they saw that my income to debt ratio was that high, I would never get a loan. Now, governments are a little bit different. The US government gets some privileges that other countries don't, just because our country is used in international exchange so much. But still, what you worry about here is that other entities will not want to hold US debt. And if other countries don't want, other individuals in other countries or individuals in the US don't want to hold government debt, then what does the government do? There's only a couple of things they can do. Pull back on the goods and services they provide, or they inflate it away. Net exports and imports. I'll go through this briefly because I ran out of time. The one thing that I think you should see here, notice here, that I cut it a little bit different, so I moved off gold flows here. Notice the Trump administration has not had much of an effect on overall imports and exports. You had this run up here, and that's just people in imports trying to get ahead of the tariffs. But if you look, there doesn't seem to be much more narrowing of the trade deficit from the tariffs. So that's something I would have expected to happen. Just because of the way, kind of the self-correcting mechanisms in the economy. So the tariffs haven't had the impact of narrowing the trade deficit like the Trump administration had asked, I hope. And also much like what again, was something I predicted last year, it wouldn't have a big impact on overall prices, and we haven't seen this. So these are data that come from Walmart, Target, though it's not listed that way, these big box stores. These are daily prices of these companies that are aggregated together. What we saw before the tariffs, that prices were trending down. And then when the tariffs were implemented, prices went up. They only went up about 4 to 6%. Corporations absorbed some of the tariff, consumers paid some of it. But again, what we should have also expected is exactly what we see here. If you have two goods that are very similar, one good goes up in price, what's going to happen to the other good? It's also going to go up in price as well. Why? Because consumers are going to switch over to that other good until those prices equalize. So not only do we see import prices going up, but domestic prices going up. Again, yeah, I would skip this one for time. You see it here, but again, it's a little bit more interesting here because what you could do is net out goods that aren't competing with imports, and you can see that those goods that Target and Walmart sell that don't have import competition, their prices didn't change. It's the type of goods that compete directly with those. When the import prices went up, so did their price. Yeah, just so you could see a little bit what was happening with the tariffs. Don't want to spend a lot of time. So this is going to take me into jobs, and I think it's a natural transition. It'll be a little bit bumpy here for a second, but this graph takes a second or two to discuss. What this says here these are the number of jobs, blue collar jobs in manufacturing, mining, construction, utility, and transportation that were created between January 2021 and January 2022. So roughly 1.2 million jobs. And then between February of 2022 and February of 2021, you had about 1.5 million jobs. So you can see positive job creation in blue collar jobs. When you get out here, notice what you're seeing. The black line is the net job creation. Is you have negative, the blue collar jobs are actually going down. You have fewer blue collar jobs. Again, why do I say that? Why did this follow tariffs? Because one of the things that the Trump administration promised is that they were going to reshore manufacturing jobs. We don't see any of that yet. None of it. Also, on top of that, you could say, well, they're coming because we're building the plants to hire these workers. When you look at the construction of manufacturing in the data, that's down as well. So it doesn't even, you could highlight and talk about the new plant that's being built in Ohio or Charlotte, but net across the country, construction of manufacturing facilities is down. So not only is employment down, construction is down, doesn't need to think that those jobs are necessarily coming back. So again, kind of a darker little picture there when we think of jobs. All my charts before, I always blocked out the pandemic because the moves in the data in the pandemic were so big, they distort the entire graph, and there's no better graph that shows this than this one. This is the change in employment in each month. And so in April of 2020, the US lost 20 million jobs, 20.5 million jobs in 1 month. And then next month, we gained back in May 4.6 million jobs. If you take this out, all of these molehills back here actually turn into mountains. Here's my emojis. That's the graph where you take the pandemic out. So you can see why you take the pandemic out, because that's a big effect that it takes that it knocks everything out. And the biggest one before, outside of this coming back from the pandemic, was this number back here, and that's when they changed how they calculated the number. So that was not actually something real. It was they figured they could do it better, and they had to push all the numbers into 1 month. So again, here's what it looks like without the pandemic. And again, here's just looking at the pandemic going forward. And again, it looks really messy at the end here. And the way to think about this is from 2020, the US added 12 million jobs. Of course, we were filling the hole in that we dug ourselves out of. 2021 was 7.5, 4.5, 2.5, 1.6. Last year it was 250,000. That was it. Again, a real concern is this weaker job growth. And again, if you add in that minus 92, these first 13 months, we've had just over 160,000 jobs added to the economy. Again, the key here is on average, you added about 133,000 jobs each month. I'll skip this one. So again, what's another concern about when we think about the job market? Underlying that number of how many jobs are created each month. So if I told you there were 150,000 new jobs created each month, what that hides is a tremendous churn in the job market. And the US is like no other country, not even countries that are similar to us, like European countries, is that like in a given month, so this black line here are job quitters. In this month alone, 3.5 million people quit their job. And then we had about 2 million people get laid off. So in order then, you have 5.5 million people in the month either quit or get laid off. That means a little bit more than 5.5 million people got jobs in order to get a positive job number. Now, if there's one thing that economists like are quitters. So what we like to see is this quit ratio rising. And why is that? Again, from that 30,000 foot view, if we see lots of people quitting, the reason why people quit their jobs is because they think they can get another job or they already have another job lined up. So from the worker's perspective, a high quit ratio means that there are a lot of job availabilities. At least that's the perception of the quitters. Okay. So we like to see that quit ratio rising. Again, this becomes a little bit alarming that we're seeing the quit ratio here fall. And again, that seems indicative of a labor market that's beginning to weaken some. If people are less willing to go on, quit their job and go look for something else. And again, there's something else that looks, again, hasn't risen to the level before, but we're starting to see a little bit of rise in layoffs as well. So on both sides here, the falling quit ratio and a little bit of a positive slope in layoffs say there could be some underlying troubles in the labor market. Unemployment rate, 4.4%, not 4.5%. I already talked about that again, trying to save time. Oops, shoot. Back. That work?
Yeah.
Good. So this is data that I pulled from the IRS. So these are tax returns of people moving into Charlotte, Atlanta, Greenville, or Greensboro. And what you can see is, so what I mean by people, it is, IRS, of course, knows where you were and where you go and how many exemptions were on the tax filing. So again, this says last year about 40,000 people, filers and exemptions listed, moved into North Carolina. It's amazing to me how well it tracks with Atlanta. And again, you can see the Charlotte area is doing a little bit better than Atlanta. And again, historically, it's done better than Greenville and Greensboro. Also in the background there, you could see I did this for every MSA. Of course, the size and the color of the circles means something. So green and big means a lot of people move to that area. So you see it right here. And purple and big and purple and small means people are moving out. So again, not much of a surprise. People are moving out of California, moving to Texas, Florida, and the Carolinas. Out of Ohio, out of Pennsylvania. But again, you see it in the graph. The next one I think is kind of important for thinking about locally. Not only is it people, you want to know households. So again, households, about 23,000 households moved to the area. Again, this is in, I should say, I'm sorry, this was in 2022. Don't pay attention to that up here, the bubbles. This graph here is from 2018. The last year I had IRS data for was 2022. So in 2022, roughly 23,000 households. Again, you think of that, I think it means maybe a little bit more than exemptions because that means primary income earners and what is the demand for housing. I'll skip this one for time. Inflation. Inflation. Again, I'm using the consumer expenditure inflation, which is the Fed's preferred number. Again, what we see here is that, again, that rise up the high inflation in 2021, 22. And again, the concern here is the red line that nets out inflation of food and energy and looks at core inflation. The fact that that's over 3 again is why the Fed is reluctant to put lower interest rates. Where we likely be heading in the near future is Powell will be stepping down and Kevin Warsh will be stepping in, and people wonder, is Kevin Warsh going to be hawkish or dovish? And like a lot of people, he's a political animal and depends on who's in office. Under the Bush administration, he was very dovish on interest rates, wanting to push interest rates down. When Obama came in office, he became a hawk. When Trump came in office, he was a dove. Biden in office, hey, we got to watch out for inflation. Let's keep interest rates high. And now Trump is in office again. Let's push interest rates down. So again, like a lot of people, we like to think economists are nonpartisan. At least academic ones are. Not all of our Fed officials are that way. I think what's going to be tough, and I'm gonna skip that last slide again because I mentioned at the outset, and again I'm over time, is what's really tough for the Fed right now is you have a weak labor market with high inflation. When inflation's high, they want to keep inflation low, so they push up interest rates, trying to pull inflation down. And then when the labor market is weak or employment's weak, they like to try to boost employment. And so they like to bring interest rates down. And so kind of they're stuck now at keeping interest rates where they're at because the pull and push of high inflation and a stagnating market, labor market. I wouldn't go as far as to say this is a period of stagflation. My goodness, I've heard people say that before, but this is not the 1970s where we had 10% inflation and 10% unemployment. We're talking 4% inflation, unemployment for 3% inflation. So But things look like they are where you're worried that it makes it more difficult for the Fed to do. A dream scenario for the Fed would be as follows, though. We get past the Iranian conflict and we get high productivity. Maybe it's led by AI. And again, what I'll argue is we've seen higher productivity lately. That's a dream scenario for the Fed. Because when productivity growth is strong, like it was 2.3%, even when the labor market softens, higher productivity growth puts downward pressure on prices. That allows the Fed to be more aggressive cutting interest rates. So the best thing that we could hope to happen is we move past the Iranian conflict and then we have this fast productivity growth. And then that allows the Fed to take its handcuffs off and try to address the employment issue. So again, I'll just kind of wrap things up. What the Fed would do with faster productivity, they can cut rates more aggressively to support employment, try to achieve a soft landing. They could raise the economy's potential growth rate. Again, if productivity is fast, then you just kind of feed into that and it won't feed into inflation. Again, one of the risks is the productivity gains may be temporary, one-time AI adoption. Of course, we also worry, again, going back to your point, is that you're throwing gas on a fire. If it's a bubble and you lower interest rates, it may make the bubble bigger and more messy when it pops. I exited.
Oh, no, you're good.
What?
I'll fix it for you.
Oh, sorry.
You're good. My house.
Again, kind of looking forward, like I mentioned at the outset, consumers look a little less robust than they did last year, worrying about debt and uncertainty. Business investments rebounding, the Trump administration. Again, one of the things that I think also that the Trump administration is doing well, I have a friend who's working in this area, is reducing regulations, reducing some of the regulatory burden, especially on small businesses. That are allowing them to grow faster. Again, an idea of allowing for small businesses to have equal footing. Again, the Federal Reserve, again, didn't change rates this week. Why? Again, because the labor market looks weaker. Core inflation ticked up above 3% outside of its comfort zone. So it's, again, not going to move interest rates until inflation starts to come down. Quick idea, Iranian impact on conflict on the economy. All but one of the 11 post-war recessions were associated with an increase in the price of oil. Consumer spending channel is important. Again, households spend only about 4% of their income on gas, but rising gas prices may have other knock-on effects. As I mentioned, I think it'll probably only have reduced real income of households between 3 and 5%, not as big as it did in the 70s. And again, the main thing is the structural conditions for a 70s style inflation are largely absent. You know, they identify 4 reasons oil shocks will have much milder effects. Smaller share of oil production, more flexible labor markets, and improvement in monetary policy. All of these things make us more agile at dealing with the rise in oil prices. So I will stop there. I have some slides on AI, but you've probably heard enough of me and I'm starting to lose my voice. I'm happy to take any questions.
Thank you so much. All right, so we've got some lunch outside. I'm going to invite folks to grab some lunch and then we'll come back and talk a little bit, reflect on what you heard. And if folks want to hear a little bit more about the AI piece, then we can see some of those slides. But you're welcome. There's drinks in the fridge over there and water, and there's food out here in the hallway. So just kind of take a little stretch break and come back to your seats. Good seeing you. Come on over.
Are you seeing it in your business?
Yeah, Yeah, I wouldn't floor it for certain. But I think if, and again, a slide that didn't make the deck was that if you looked at housing construction, we've been down for now 20 years overall. So I think it would take an awful lot to overshoot at this point. So I think it would be hard pressed to overshoot, but it would be a concern that if we continue building for the next 15, 20 years, then we run into the problem with an excess supply. But I think, using your terminology, you may see more aging out of the baby boomers. And so I think you would see that price more regulate itself rather than being the big drop off.
How much share of that is in migration? Because you would think that all your big purple, right, now would show a slowdown in or a housing price reduction in big purple areas and increased price production in big green areas. And there doesn't seem to be a correlation to those two at all. Housing prices are just as high as they've always been in California. Less net migration, that doesn't make any sense to me on the supply and demand side.
I had answered that and I lost it. I think, yeah, again, I just think that the demand, the outflow from California, say in New York, while the absolute number is big, it's not big relative to the size that they're moving from. So I think if you look, again, the easier examples would be if you looked at Ohio or West Virginia, where for a while you had it, though in Detroit, those were large numbers in terms of absolute number, also in terms of percentage. You did really see a collapse in the housing. Whereas in California and New York, it's a big number, but it's relative. It's not nearly large.
Christina.
I want to add some flavor to this on regionalism and the role of understanding who each other has in their communities, because you're all an island to yourself of your own commissioners, your own tax base, your own zoning, your own resources. But yet those resources are shared when it comes to jobs, transportation, utilities, communications, and quality of life. And so there seems to be an opportunity to work regionally to better understand the resources and capacity that we all have in our housing and in our quality of life and in our economic well-being. And working better together to ensure what you approve and use locally makes sense and doesn't usurp or overproduce something that actually isn't what the region is smart size for, economically robust for. So you are all surviving on your own and not needed to or required to speak to each other. But I've been hearing more about this opportunity to understand each better regionally, particularly from our housing and our capacity needs. And I was talking to a professor about this and he recommended a book, which I'm going to read, is Scarce Resources. We are now at water, sewer, utility, traffic, schools, cost of healthcare, cost of running our governments. That are really, really difficult decisions for all of you when you go into budget time. Doing that work alone or not understanding how it flows to your neighbors or the push and pull of jobs and capacity and transportation and transit is really an important thing. So how does that feel? Do you feel like you regionally understand what each other is doing, or does that seems like a good idea, or am I crazy? I don't know, because economically we move as a region. We really do, and I think that's what Professor's data had really shown. We look at the aggregation of our economy. It is region one, and you're all a critical component of it. So I just offer that up as food for thought.
I think certainly on the housing side, I think it'd be good to know like what types of units we're producing, where we're producing it, to get to your point, Commissioner, right? If everyone is building the same type of housing, everyone's building multifamily, and then we're not regionally producing enough single family or enough executive level housing. I hear from some of our Gaston County folks, Stanley County folks, even Cabarrus County, we need more executive level housing, which is a very different need than more affordable housing. So like the diversity of what our communities need and then really looking at what we're producing where is, I think, an important point. For our finance directors in the room, I'm curious on what the professors' thoughts were on how they resonated with you on things like your sales tax forecast and maybe even property tax. You know, putting our finance directors on the spot here. What's your takeaway? Are you optimistic about, you know, the next year? Say more. You're shaking your head.
So I mentioned this to the professor,
Introduce yourself. Sorry.
I'm Jason. I'm with Union County. I'm budget grants director for Union County. The concern that we have from a county point of view is we have a number of different things that are running against us. We didn't talk about HR1 or the One Big Beautiful Bill. North Carolina is one of 10 states where that's done at the county level. So we're going to lose 50% of our federal funding related to F&S certification. We're also truncating that process from 12 months to 6 months and effectively, most likely doubling my need for that workforce. In addition, I've got utility, water, wastewater expenses that are going to be going up and increasing, and the electricity costs. I just came from Virginia where they're on the PJM network and they're seeing, 20% growth year over year in electricity price. That's the struggle that we have. You put that on top of healthcare where you've got, and I think GLP-1s are great, but they're very expensive. And healthcare is growing at 20%. And so we don't have a lot of levers that I can go to be able to turn that up, to be able to meet those reductions in revenues while I'm still trying to compete in the regional against all of you for additional individuals to come and work in Union County and work here to be able to go do that. And so every time another municipality goes up on police pay or on firefighter pay or on other areas where we're all competing for the same group of folks, it causes us to have to pay more. And so that is the struggle that we have, at least in Union County.
Yeah. Justin, you're shaking your head in agreement. Give us the Gaston County perspective.
It's the same, this is what Jason just mentioned. It's HR1, it's employee healthcare costs. I talked to Jason earlier and I told him we're raising the cost of our employee share of their health plans for the first time in 11 years. And that's a total different story. You probably should have adjusted it before now, but we're facing attrition, trying to attract employees and trying to find ways to make this a net zero. We're going to increase the cost of insurance on employees, make sure they get a cost of living increase that's at least to the break even. And it's hard. Like we're having to hire 40 people on our DSS to combat the losses that we're going to face on HR1. We're looking at SNAP. 30% of our population is on SNAP, and if that's reduced from a federal level, the economic impact of that alone will be catastrophic for our community, for our people who buy grocery in our grocery stores. So it is not looking great for her.
And that's that government spending piece that you talked about, right?
But it's really on the consumer side is that it was, again, it was on the cutting floor. I took off because you can only have so much, but one big part of the One Big Beautiful Bill, there was some positive things on the consumption side that were the no tax on overtime and the no tax on tips, but beginning this year is where you get the cuts and the benefits and where you have to work to show the additional hours of work or community service. The first year was going to be positive, but the second year, because of the reduction in SNAP and some of the other assistance programs, are going to really impact lower income housing. And like I said, really put an increase in demand on community service, DSS, and all of that. It's I think it's going to be bad in certain areas.
If I could just add to the other concern, just, the grenade at the end of this is the error rate. So again, in North Carolina, it's going to be based at a state level. Whereas if Union County has an error rate of 3%, but the state's at 7.5, we're Right now, I pick up 5% of the total cost of that program. That is very large numbers that a county, and especially, I'm a county that's outside of the Mecklenburg area, so I have some financial resources to be able to put towards that. I've been in other counties that did not. And so if you're in a county in Western North Carolina and you have $1 million to $2 million hit and your total DSS budget is 4, that is a huge hit for them. And again, it's a zero-sum game. Most of these locales are not wanting to go and increase tax rates to be able to supplant those dollars. So you're doing more with less, and you continue to do more with less. Generally, that increases your error rate. That's the concern, is that this sets up a downward spiral. Not to be completely doom and gloom.
Aw.
It's budget season.
It's like therapy. So we got a few of our elected officials in the room. I'm curious from your perspective, what trend or little information point you heard from the professor kind of weighs on your mind a little bit? Tony?
What percentage of consumer spending did you say affects GDP?
Consumers are 67% of GDP, 2/3.
Then my takeaway was to see your graphs of how suddenly we're doing credit cards, we're buying fine automobiles. Where are we lacking? Because to me, that is very troubling. Long term, what would result if we change the education to where we teach people don't know how to handle money? It's obvious. That takes a generation. You're talking 20 years.
No, well, I think it does involve some education, but again, I think also, I think some of the income inequality that we're seeing is people are just trying to spend their way out of that, keeping up with, I hate to say keeping up with the Joneses isn't the right thing, but I think coming off of the kind of the sugar rush that we were on during coming out of the pandemic and the stimulus, we've continued to want to buy those things, and people haven't pulled back on their spending, be more in line. Whether that'll continue or not, I don't know.
So can I follow one thing? My customer base in my business is 80% immigrants. Those people know how to use our financial system a lot better than us sitting. These people come to this country and within 10 years, they're buying things. I watch it. I'm dealing with a lot of Ukrainians right now out of the war zone. These people are here a year or two, and next thing I know, they are flourishing. What do they know? What is their education? What's happened to us? We're sitting in the promised land, and these people come in and just boom.
I think it defies a lot of the economics that I would I think we have a generation that I'm going to throw my own children under the bus for that they became used to the abundance that we had, and they don't plan, or I don't want to say work as hard, but they don't plan nearly as well as other generations did. And I think a lot of times when the immigrants come in to the country, again, they know in some ways some of the cards are stacked against them. And so they behave a little bit different, trying to self-insure a lot. And my kids still realize that if they do something stupid, I'm there to bail them out. And I think that's just led to spending behavior and other behavior that's a little bit more wasteful. But I think the big thing is I think the immigrants come in, and again, they know it's more of a challenge, and so they self-insure against that.
Thank you.
I think it comes in down to culture as well. Whenever you have your immigrants coming in, their culture is that they bound together as a family, take care of each other. Whereas we in the United States, our families are broken. And
You're right.
it basically comes down to culture and to what's important to them.
Yeah,
And you see that in the remittance data, the amount of money that these families, when they come here, how much they send back home to support their families, it shows a little bit stronger.
Mr. Chair, I'm gonna give you a last word before we wrap it
I
up.
don't want the last word, but my takeaway is that, I think the electeds, especially the room, will have increasing pressure for housing. Increasing our housing stock in our towns and communities is gonna be huge. And that slide, one of your slides, I'm pointing to that one. But on the wall there was, that's one of the big things. There's not enough housing. And we're gonna need to probably feel more pressure, which I was on a webinar yesterday. That was the whole theme. I'm like, you gotta be kidding. We have to, well, is there anyone here from Charlotte? County or town government?
Yes,
I know Matthews, I mean Charlotte.
Oh,
No,
Charlotte.
Councilmember Mayfield has a lead, so.
Oh, cool, then I can say what I'm saying. Charlotte's zoning, in my opinion, has gone crazy. You can put in Myers Park, drive around through Myers Park sometime and you'll see mega, well, not mega, these are old mansions. Right next to, they cleared the lot and then that lot next door, they built a small condo complex. That just applies so different than what us out in suburbs, I guess, first. But that's the pressure they were talking about yesterday, is that we need to allow more development and lessen the rules, which in some cases means changing the housing codes, the building codes, I mean, which are already not even as current as they should be. So I just think that we're gonna feel more and more pressure to add housing stock to our community.
Absolutely. Well, thank you all for joining. We do have on your tables a little flyer of an upcoming event. David Hollers from our Centralina Workforce Development Board and our great team there is going to be doing a Centralina Learns coming up on the 26th on registered apprenticeships. This is a big priority in the state, and we're going to be featuring some great examples of how apprenticeships have found their way into our local governments and how you can actually have an apprenticeship program to train folks in finance and.
Yeah, primarily I hear from every one of y'all. Can I find people, police, fire, EMS, general services? You'll learn from the experts. Dana Cheney's the HR director at the city of Albemarle, and Jeannie Taylor of Iredell County. Both of them have successfully used registered apprenticeship for their hiring and they're building their talent pipelines. Great opportunity to connect, but also for other services. We've done finance with the town and HR with the town of Mooresville. So yeah, come to register for this. It's 10:30 to 12. You can do it either in person here, or you can also do it online through that. And just to give Scott a little props, I appreciate everything. I've been around working here since the Reagan administration, so I've seen all the different sessions you've had. We've been through Pilatex laying off 4,650 people in July 30, 2003 in this region. So we understand that. But also, you're very encouraging looking at the region. You have a lot of people moving in here. If you look from year to year, our labor force in every one of our counties has increased. Union County's increased 3,000 last year. That's what's helped to drive it. This is an attractive region, so we do have that going for us in the last few years. It does put a pressure on housing and other roads and schools and all that, but that keeps our labor force in place and really moving forward.
Better than the alternative.
Better than alternative, so don't always look at the unemployment rate. Flip, there's a second page that the Labor Economic Analysis Division of Commerce does, and it has on there the labor force in your county. You'll find out how many people are increasing labor force month to month, how many more people employed. The unemployment rate usually stands about the same. Most people are in and out, moving in, but you do have a lot of folks in are coming here to work, already have jobs available, or know that they're great jobs here.
Creating a lot of interesting issues for all of you to grapple with in your communities, but I hope you enjoyed today's presentation. Another round of applause for our speaker. Thank you all for coming out to Centralina, and I hope you have a great rest of your Friday and a wonderful weekend. We'll look to see you back soon. Thank you. Yeah.
Which one? Whatever. He's
You know, man, Sheriff, let's say, brother, someone else, you know, I was here.
Well, sure.